For more on LinkedIn, let's bring in Michael Moe. He runs GSV Asset Management, a firm focused on venture capital investing. He's also on the board of SharesPost, the private exchange where up until now was the place to go for trading in LinkedIn shares. Michael, welcome back to Bloomberg West. Always good to see you. Okay, Cory told us, big valuation. What do you think?
Well, I think what you're really seeing is growth investors have been in the desert for a very long time, and so now here's a big, full pitcher of water, and so everybody's all after it, and it makes good sense. I mean, LinkedIn is a phenomenal business.
At the same time, we know the retail interest in this deal was big, and a lot of people think about Facebook. Maybe some people are trying to compare this company to Facebook. Do you have a worry for investors who are jumping on this boat?
Well, clearly, the valuation for LinkedIn is rich. I mean, it's not like it's an inexpensive company at a $4.2 billion valuation. At the same time, they have true network effects, tremendous leverage to their operating model, great people, all the things you look for in a premier growth company. So, it's not for the faint of heart, but often when you find a really, truly exceptional business, the best idea is to take a deep breath, close your eyes, and hang on for the ride.
Yeah, so Michael, Cory Johnson out here. Glad to have you on the show. You were around, we were around in the last bubble, and you saw a lot of companies come out like this. Some grew up to be great big companies. Others became, Pets.com and DrCoop.com. How can we look at this company and evaluate what's really there?
Well, first of all, I think you got to look at the overall context, which is basically you have an environment where growth companies really aren't selling at rich premiums to ordinary companies. So you have a multiple for NASDAQ at about 15 times earnings. The greatest growth company in the world, Apple, selling at 13 times earnings. So it's hard to make the argument that the environment is overheated and so forth. I think what LinkedIn is an interesting business. It's the first social media business out there. What's been shown is that on the internet, it's all about disproportionate gain to a leader in a category. LinkedIn has a niche that they own, and so there's great operating leverage. And I think the key part is that there's differentiation between the LinkedIns and Facebooks and the DrCoops and the Pet.coms.
Now, you were on the other side of these kinds of deals. You weren't out there buying stock. You're out there helping companies go public. Do bankers, when they're working on these deals, know which ones are dogs and which ones are actually truly great companies?
Well, I mean, that's a great question. I mean, I think the great investment bankers, I think, have a fundamental belief that if you help the clients, the investors make money, everything takes care of itself. And so taking companies public where investors they don't think are going to do well, the really good investment banks, the really good investment bankers don't have that. That's not to say they're going to be right, but that's not the attitude. Unfortunately, that's not always the case. And when your incentive is to make a fee, and sometimes you overlook some of the broader responsibility and sort of the long-term consequences. But I think generally speaking, the better investment bankers and the better investment banks, they truly believe in what they're selling.
Michael, I mentioned that LinkedIn has a valuation that exceeds that of AMR, the parent of American Airlines. You could make the argument that without the airlines, the U.S. economy would be in more trouble than if we didn't have social networking firms. But now that the bar has been set high, what are the pitfalls, the things that LinkedIn has to avoid?
Well, I mean, again, in terms of where valuations are at, and the market ultimately is rational and efficient, effectively it's looking ahead at where earnings power is, not behind in terms of maybe relevance or importance. There's no question that the airline industry is fundamentally crucial to our economy and the global economy. I think the pitfalls for LinkedIn is, one, to earn the valuation that it has to continue to grow very, very fast. I mean, it's growing at 100% plus top line. And importantly, as Cory was talking about, it's got to show it ultimately to the bottom line. So showing continued operating leverage, going from a relatively insignificant profit to larger while growing very fast is going to be fundamental to the valuation.
I'm joined again by Michael Moe of GSV Asset Management. And also joining us now is Liz Beyer of Class 5 Group, who comes to us from Palo Alto. Class 5 helps companies considering going public. Liz has lots of IPO experience and also advised Google on its public offering. Liz, let's start with you. Give us the grade now that we have the numbers. Where does this IPO offering rank for you?
Oh, it's hats off to them. Any company that can raise the price, the expectation the day before by 30% and still price at the high end, hats off to them. They're clearly raising a lot of money for some folks who've been working pretty hard for 8 years.
Hats off to them, and yet you're still wondering whether Facebook is actually paying a lot of attention to the pricing of this deal.
I think this deal is very different from that deal, and I think everyone in the Valley who's thinking of going public is surely looking at this and thinking, oh, good, for rapid growth companies, there's a market. But I think the folks at Facebook, as I've said before, are going to go on their own schedule at their own time, and their business model is so tremendously different that it's not a direct comparison. What's the same about these two companies is that they collect individuals and let them communicate with each other, but it sort of stops there.
Liz, I wonder if when you look at this deal, though, there is something about a common thread of consumer-facing internet companies that resonates with users who might not follow the markets and might not follow the IPO market, but know that there's something new about technology and they want to get involved.
Oh, absolutely. And Cory, we know this from, 10 years ago when we were doing this. The big consumer names, whether they're in technology or frankly, whether they're golf clubs or motorcycles, almost always get a boost on IPO day from consumers who say, I want to own a piece of that. Clearly that's happening here. And that certainly will extend to whenever it chooses to go, Facebook and Zynga and Twitter and, the big five.
So, a question I asked Michael, what's to let us know that this is different than golfclubs.com or Webvan or any other sort of promising IPO venture that turned out to be a disaster?
So two answers. One, you never know. Oh, sorry. Sorry, go ahead, Michael.
Well, no. Well, and that's, I agree with what Liz just said. You never know, but I think when you look at the characteristics of any great growth business, you look for what I call the 4 Ps: great people, leading product, huge potential, predictability, and certainly LinkedIn has that. One comment about why these consumer type of, whether it's golf clubs or restaurants or internet companies, seem to have that much more interest is, people forget institutional investors are people too. And so things that they actually utilize and they can touch and feel than their spouse does, all of that has just that much more interest and appeal.
But you talked about this being a growth business. Are there not other places where investors can find growth right now, or this kind of growth?
Well, unfortunately, because the IPO market has been so lackluster in the last decade, basically IPOs are off 80% in the past 10 years. Many of the important, what I call stars of tomorrow, are still private. And so everybody talks about LinkedIn, Groupon, Facebook, Twitter, Zynga, but there's 2,000 to 4,000 private companies, VC-backed private companies that have over $100 million market value and growing very fast. So there's a big appetite for investors for growth, but there's very little or a lot less than they want in the public markets.
And that does raise the question of those many companies, how many really should be going public?
Well, Liz and I would have a little bit different of opinion here, but I think the reality is there's many of these companies that could go public, but shouldn't go public for a variety of reasons. Being public, it means you're a long time and there's different type of responsibilities. But I think the reality is, I think there's more companies that should and could go public than we've seen in the last 5, 7, 8 years. The reality is far fewer should and will go public than what we saw back in the good old days.
Hey, Michael, what's different technologically that lets companies like LinkedIn and Facebook and companies we expect to IPO, and obviously LinkedIn IPOing tomorrow? I'm using IPO as a verb. I hate that. But what's different now? Technology.
Well, I think one huge difference than 10 years ago is you're able to see businesses grow massively with relatively small amounts of investment capital. The internet, you've seen the efficiency behind many of these business models that allow them to scale and grow very fast without having to take in hundreds of millions of dollars. So that's one thing. And secondly, they're able to dial in the profitability a lot quicker as well, which gives you more flexibility, because a lot of times you saw businesses go public because they needed to go public, they needed that capital. Today, that's not as much an issue. So I think the reality of it is, you're seeing a lot more efficiency, you're seeing a lot more discipline, you're seeing business models that candidly, from an ROI and from the investors that are in, much more attractive than what you saw back when you saw the initial development of this marketplace.
Liz, before we go to break, what do you think about performance tomorrow? Everyone's going to be watching this deal. How do you think it'll perform when it starts trading?
You know what? That's betting on a horse race ahead of time. With this much enthusiasm and with so much individual interest, assuming nothing else big is going on in the market, there's every indication it'll do just fine. But we'll all see that tomorrow, and there's no glory in betting on it ahead.
Fair point. Liz is going to stick around with us, and our thanks to Michael Moe, who's been joining us with this developing story. Michael, thanks. Liz, you were with us just a couple of weeks ago when Ren went public, and it had a big, glorious debut. It was up something like 30%, and since then, it's down in the neighborhood of 20+%. A wild ride, to say the least. Is that something that investors who didn't participate in the LinkedIn IPO or have to keep in mind if they're thinking of buying this stock, say, tomorrow or in the next couple of days?
Oh, absolutely, and that's no disparagement to LinkedIn at all, but IPOs are, they call them unseasoned issues. They can do virtually anything. There can be huge enthusiasm day one, and then oh wow, what did I do day two? Or they can keep moving up. It's why I didn't want to directly answer your question a minute ago. We don't know what it does tomorrow. The fact of the matter is whatever an IPO does on day one is nice for the headlines, but pretty much irrelevant for the long term. It's what the company does in terms of performance. Can it keep that growth going? Can it remain profitable? That's what's going to matter to investors in the long run. Tomorrow's kind of a game.
All right, let's talk about what happened on this roadshow for the IPO. Clearly, it was successful. You know, it was taking place when Microsoft acquired Skype, a company, of course, that was planning to go public itself. A lot of times when companies get ready to go public, they don't end up getting acquired. Do you think during this roadshow, LinkedIn may have received offers from other people who wanted to buy the company, further fueling the excitement towards the IPO?
You know, I learned long ago not to speculate about things where you have no data on camera. So they do say in general, when companies file the documents for an IPO and they put out all that information about their financials, there's a reasonably good chance that if there are larger companies that are interested, they're reading the details very carefully. So it's not at all uncommon for companies to file and then be acquired. But in any specific case, in the specific case of LinkedIn, don't know. I think the enthusiasm for LinkedIn is that everybody is familiar with the name, it's growing rapidly, and it's a profitable company.
Liz, in the advice that you give companies before they go public, how much in terms of pricing, you know, if you look at it from a company standpoint, at first blush, you might say a company wants the highest price possible. They want to take every single dollar off the table and use it for corporate benefit. But what is the benefit of having an IPO that will go up after the offering, leaving some money on the table so the investor gets a pop? What's the benefit to a company?
You know, the hardest, I'm going to get directly to your answer in a minute, but the hardest part is figuring out how much to leave on the table. It's great to come out of the chute and have some momentum behind you, and that makes the investors who were allocated shares on the IPO enthusiastic to pick up more shares. And when a stock begins to trade down right away, it kind of scares people, thinking, what do other investors know that I don't? So the initial momentum does matter. The challenge is, how can you price it so it's up 10 to 15% versus 60%? Because 60%, arguably, you left too much on the table.
But I understand why that's good for the investment bank, right? Because they're going to have another deal to sell to those investors. But a company is going public to get the money and to get some liquidity. Why? What possible good could it have for a company once they've done their once and only IPO to leave money on the table?
So every company has different reasons for going. If you're in some capital-intensive business, you really do want to collect as much money during that deal as you possibly can because you have a use for it. On the other hand, many companies do smaller deals up front, thinking in 6 months, when the market knows who we are, we'll do a bigger deal. Well, it's much easier to do a bigger deal 6 months down the road if you left something for investors the first time around. So it really very much depends on, why is the company actually going now? What are they going to do with that money? And what are they thinking about in terms of 6 months, a year from now?
Liz, very quickly, got about 20 seconds left. A lot of this deal involves insiders and investors selling stock, about a third. So that's not going to the company. Is that about usual with some of these deals, or Google comparatively?
Oh, no, it's high. Now, again, the company is older, so there's an understandable reason, and obviously investors didn't care. But no, a third is pretty high.
All right. Liz, thank you so much again for the time, your perspective on this. Liz Buyer of Class 5 Group, of course.